Good morning, this is Andrew from Trend Following Mentor. Today is January 9th, 2014. And what we're going to look at is the stock market from a trend following perspective and looking at trend breakouts, trend retracements. And first thing that we always do is we look at what the stock market's doing. And I was in a meeting actually yesterday and had a conversation with a gentleman who's managing a pretty large hedge fund. He said, you can't call a top or a bottom in the stock market. I said, well, you don't have to call a top or a bottom, but you can know where you stand. And there are tools almost like what an x-ray does. I mean, you think about it, you can't see inside a body, but with an x-ray you can kind of get an idea. What the idea is for us with the stock market is there is internals of the stock market, which are the advanced decline line. You have all different attributes. Another thing that I really strongly suggest is learning about distribution days, which signifies that there's more selling than buying at points. And when you have a series of these trades, like 6, 7 of them, statistically and historically, the market has topped out. Well, right now, we had 7. It reduced to 6 because one fell off due to a time after about, I think it's 25 days. So really where we are is the market internally, which I've been very concerned about, is improving to some, let's say, slight degree. The advanced decline line's improving. You have one distribution day that's fallen off. You had nice volume yesterday. And to put everything balanced, there's still a lot of negatives. The negatives is the margin debt, which is extreme high levels, which has signified market tops in the past historically, as well as you have a tremendous amount of investor bullishness. And let's say there's a reading from investor advisors that if it surpasses a certain threshold, it's a pretty big negative. Well, we surpassed one of the highest readings of 61.8%, which was the height of the last bull market, and from there it started turning down. So again, what we do is we look at the stock market first, get a bearing of where we're at, very using simple ideas, because the only thing that can really hold up in the real world is simple. I use 10 and 30 exponential moving averages as a first indicator and a 200-day exponential moving average. If I'm above all of these, which we are currently, the market's favorable. But there's some internals that are negative also. Not everything is black and white. There's a weakness. You're showing, actually it's a divergence in the MACD where we're going to new highs, or we were at new highs, yet it's not showing that internal strength. It's going down. So that's a negative. But what I want to do, I jumped to the wrong window. What I want to show is basically a trade that is common, that you can replicate, that can be part of your trading plan. But the idea is the entries on their own mean nothing. Really, they mean nothing. Everyone searches for the entries, but that's not the key. The key is having a trading plan, which is knowing what to buy, what to sell, how much to buy or sell, and when to exit with a profit and loss. And then to put on all of it is to have the right mental fortitude to withstand let's say groups of drawdowns or consecutive trades that don't work, because I promise you they will happen. I will promise you that you will have long durations of trades that you don't make any money, long periods. So basically I'm going to show 2 things. This stock, this Astrotronics, whatever the heck it is, I don't know, whatever it does, was one of the strongest stocks in one of the strongest sectors, and you can do this by a ranking, and I have an indicator here, very simple. It's called Trend Following Mentor Ranking. If you want, I can email it to you. Just email me gladly. So this showed up. So I knew it was one of the strongest stocks. It was part of my universe. What interests me with this and what happened was it was pulling back to the 50-period exponential moving average. You can see it here. You can see it here. You can see here. When it hits the 50, many times it bounces right off. And the sooner, let's say the beginning, the first, let's say several times it does that, you have a greater propensity for the trade to work. But I took this trade the other day. I bought the breakout here. It was a very low-risk trade. I was buying at 50.89, risking down to 50.15, buying out the high, risking down to the lows. If the trade works, great. If it didn't work, well, whatever, who cares? Because it's just one of the next 1,000 trades. But this trade kind of stumbled into a nice big trade. Not that I knew anything. Had 4 big up days. And you don't know what will happen. This is what trading is. And you make your money by position sizing. And this is like in position sizing, I discussed that in one of my books, or actually probably all of my books. I talk about position sizing, because this is really, if there's a holy grail, it's position sizing in the Bible of trend following. But this is a great trade. This is just not the idea to tell you to go buy this, because everything I'm telling you or trying to do is teach you how that you can be independent. Not to teach you any particular trade or any tip. Forget that. You need to learn how to trade. You need to look for setups. You need to learn money management. You need to learn risk management. You need to learn the proper psychology to get into trades like this. And even more, you always have to learn about yourself. And that leads to this next trade. I was in micron technology. Simple idea again. Had a pullback. I got in here. There were numerous reasons I got in here from the force index. It was hitting support. I bought here. It really wasn't working. And then what happened is that the stock pulled back. Earnings were coming in. And then I thought, let me err to the side of caution as opposed to the side of greed. And I just said, before the earnings come out, because anything can happen with earnings reports, just close the position, scratch it, which I did. It was a break even. And then Murphy's Law, which will happen all the time to you, it gapped up. It gapped up huge. So what do I learn from this? Because again, I strongly suggest you keep a trading diary. What I wrote in my diary is, right before earnings, and if I'm not in a winning situation or a trade that's working, sell half of it and see what happens. It's just something for you to contemplate, because we're always all learning. And this is what the key is. And I wrote one of my blog posts yesterday, which I thought was, I got a lot of emails about it. This one, if it opens, was about which trader you should listen to. A trader who talks about his mistakes is the person you want to listen to. Avoid the trader who doesn't admit being wrong, because they're dangerous. This is what I do. And if I can help you in any way, please, I'm here to help you. And again, you might want to pick up one of my books. They can help you. I wrote them for my children. Again, this is Andrew from Trend Following Mentor. Thank you very much.